Whenever markets become uncertain, people naturally look for predictions. Where will the prices grow? Have we reached the bottom? When will interest rates fall? Which city is going to outperform the other? These are all understandable questions that many investors are asking themselves right now. But after spending, multiple decades helping Australians, build property portfolios, one of the things that I've really noticed is that the investors who build the most resilient wealth really spend their time trying to predict the next headline. What they do is they spend their most time preparing for multiple different outcomes and scenarios, because ultimately they understand something important, and that's predictions eventually become outdated. Frameworks do not, however. And this is really what today's discussion has ultimately been all about. Not convincing you that one city is ultimately better than another. We're certainly not suggesting that every investor should be buying a property, and we're not suggesting that every investor should wait, but instead asking yourself whether your portfolio is positioned for the environment that we're actually in rather than the environment that we hope will return. Because those are two very, very different conversations.
Yeah, the evidence we have discussed today do not suggest that all markets are strengthening or that all markets are weakening. It suggests that different segments are responding to different economic drivers, and understanding those differences allow the investors to make decision based on evidence-based rather than broader national averages.
Yeah, look, exactly right. And perhaps that's probably the biggest lesson from today's episode is that, the Australian property market is not behaving as one market now. It's behaving as many markets. Some supported by obviously structural demand, some responding to borrowing capacity, some are entering into a period of adjustment naturally, and others are continuing to experience, that genuine momentum within the market. And if we keep treating all of those markets as if they are all identical, then ultimately we risk making decisions based on averages rather than reality. So before, you make your next investment decision, I would encourage you to ask yourself one question, which is not where is the market going, but ask whether your portfolio is positioned for the market that you are actually in. Because once you answer that question, everything else sort of becomes much clearer. And if today's discussion has done anything, what I'd hope that it has encouraged is for you to think a little bit differently. Not more emotionally, certainly not more strategically, because that's exactly how we approach every single conversation at Ramsey. We begin with your portfolio, your lending, your debt structure, your strategy, your objectives, and your next decision. It's not a generic recommendation. It's not a one-size-fits-all approach or solution. It's just a disciplined review of actually where you're at today and where you're trying to get to tomorrow. So is divergence not a correction? The data says that the market is splitting, it's not falling. And the question, is not which way the market is actually going to go, but the question is which part of the market do you want to play in, and whether or not your portfolio is actually structured for the position of the part of the market that is actually moving. So if you want this model to your actual situation, your assets, your debt structure, and your next move, a discovery session with the team would probably be where that conversation might start. It's not a sales pitch, it's not a diagnostic, but what we will tell you is what we see, and you'll decide whether or not that's worth not taking it further or not.
Thank you for joining us.
I'm Ewan Ramsey.
And I'm Dr. Prabhat Morogake.
Thanks for watching, and if you enjoyed the show today, don't forget to go ahead and subscribe to the channel by clicking in the bell icon below.